as a financial advisor, one of the things I do when people reach out and are considering working with me is I often will look at their existing portfolio and share my observations. And now that I've been a financial advisor for over 2 decades, I've literally looked at hundreds of portfolios, maybe even thousands. And here's the top 5 things that I learned that can really become a gotcha if you're not careful. So let's jump in. And the first one is your portfolio is likely riskier than what you think it is. Either because some of the stocks might move together in certain situations, like financial stocks did during the great financial crisis, like many stocks moved together during COVID, unless they were companies that were considered essential and were able to stay open. So either because stocks are moving together in a way that you may not have thought of, or because your bonds are not as safe and secure as what you thought they were. Many people would say a U.S. government bond is the most secure, the least risky bond out there. But if you've stretched for yield and maybe you have some 30-year bonds, just as an example, even if they're from the U.S. government, yes, you'll get your money back, but what happens as interest rates go up, like we all saw in 2022, when people saw their bond portfolios get hit every bit as hard as their stock portfolio. Sometimes there's credit risk with bonds, and sometimes there's what I call duration risk. If interest rates rise by a percentage point and you have a bond that's maturing in 12 months, well, you probably lost about 1% on that bond because you can just hold on to it for a year and then get paid back. You've only lost 1%. But if you have a 30-year bond, even if it's backed by the U.S. government, you have duration risk. Because now you're locked in and getting 1% less than maybe the current bond, that 30-year U.S. Treasury that you could buy. So you're losing out on 1 percentage point over 30 years. So the current value of that's probably you're down 18%, right around there. So your portfolio is likely riskier than you think it is. The second one is your portfolio, unfortunately, is probably more costly than what you think it is. There's probably more hidden fees, there's more costs, there's more events and transactions that can happen or do happen that trigger taxes for you, even though you may not have liquidated that position. So looking at what the full-in cost of a portfolio is often surprising to people. Okay, the third one is your portfolio is likely over-diversified. It's more diversified than it needs to be. I've seen people slice and dice the S&P 500 where they have 3 different ETFs, but collectively they end up having the whole S&P 500. For instance, you can buy certain sectors within the S&P 500. You can buy the information, the telecommunications sector, you can buy the finance sector, you can buy the technology sector. But if you own all the sectors, guess what? You have the S&P 500, and why not reduce your costs and just hold the S&P 500? That's a silly example, but I've seen things like that. I've also seen things where a portfolio has maybe the S&P 500 in it, and it has a big position in one of the large stocks in the S&P 500, and at the same time that portfolio manager is shorting that stock. So they're long in the S&P with it, and then they're short that exact stock. So in which case you're paying a cost that you don't need to. And speaking of the S&P 500, why I say you're likely over-diversified, you have much more diversification than what you need to achieve your goals. In some ways, you're under-diversified. So that's point number 3 and 4 is you're likely over-diversified and you're likely under-diversified when it comes to certain positions. Let me give you an example. The S&P 500 that we were talking about earlier, which are the 500 largest caps in the United States, largest cap stocks in the United States. The Magnificent Seven, the top 7 positions in the S&P 500, that makes up 31%. The top 7 positions make up 31% of the entire exposure that the S&P 500 is getting from the stock market. The top 10 make up over a third, make up 37%. The top 10 positions in the S&P 500 is almost 40% of the S&P 500. Oftentimes people are surprised to hear that. And it has changed dramatically as recently as 2014. Instead of those top 10 positions being 37%, they were just 14%. So we've seen a dramatic concentration in the S&P 500 and other ETFs, so you need to be aware of that. Another thing, and I hate to be the bearer of bad news, and people are going to, please be kind in the comments, people aren't going to like hearing this, but multiple studies have shown that we, as human beings, are our own worst enemy when it comes to our portfolio performance. There's a think tank called DALBAR, D-A-L-B-A-R, and they look at 401k, the offerings, the stock offerings in 401ks as well as other asset classes. And they say, how did the average individual investor, the retail investor, do building a portfolio amongst these? And what they see is, as individuals, we do dramatically worse than the investments in which we're choosing. And the reason for that, they call it the investor behavior penalty. And what they say is, as humans, we're all wired emotionally, because of evolution, we've been wired to, be attracted to things that we want more of, which is positive returns, and to run away from things that scare us, which are things like positions that are down 20, 30, 40%. So we chase what worked last year and we run away from what did not work. And unfortunately, the impact of that is we're leaving a lot of money on the table. And that behavior, investor behavior penalty makes a dramatic difference to our success over a period of time. So what can we do to overcome these things? Well, one thing we can do is just to get a second opinion. Now, I'm a big fan of, obviously I'm biased, but to get a second opinion from a professional. But if you have another peer that's also getting ready to retire and is looking at these things, at least get a second opinion from a friend, somebody else going through the journey at a similar phase. But when it comes to financial planning, I definitely don't think you want to make the decision to retire. Do you have enough to retire? What does that look like in retirement? There are people out there that'll say you can spend 8% a year in retirement. And if you look at the statistical models, if you look at a lot of the actual results, that's a plan that can get you in trouble. And I don't want to see you get in trouble. So hiring a professional, preferably somebody that's a fiduciary to you 100% of the time. One of our biggest risks is ourselves, so how do we negate that risk? And we negate it by having people that have helped hundreds of families help us with this. Another big risk that we all face is the risk that we're going to give up enjoying what could be the best years of our lives, our 50s, our 60s, our 70s, what I call the youth of our senior years. And that's why I made this video here, 7 things to stop doing as we approach our 70s. Thanks for watching, I'm sorry, as we're in our 50s and 60s. Thanks for watching this video. I'll see you in the next one. Bye-bye.